So in chapter 18, we spoke about the financial markets and the euro. And this is the final chapter of the semester. We're going to talk about the financial crisis and how it affected the euro. So we have to keep in mind that the European Union or the Eurozone adopted the euro on 1st January 1999, and then financial crisis pretty much hit on its on its ninth year, which would be 2008 or so. So that is absolutely not an optimal time for financial crisis or any crisis to hit, especially a financial crisis because it affects the financial markets. So let's start with a discussion on how the financial crisis happened. So that's section 19.1, stage one, the global financial crisis. So between the years of 2001 and 2007, these years were particularly beneficial for both the US and the Eurozone countries because at the end of 2001 saw also the end of the dot-com bubble burst or high-tech crisis. And then towards the end of 2007, middle of 2008, you saw the start of financial crisis. So these two the years in between these two crises were extremely fruitful for both of these economic areas because they were characterized by, and to a great extent, the rest of the world as well, characterized by an unprecedented period of prosperity, specifically through the combination of sustained growth and declining inflation. So usually what ends up happening, or in the past what had happened in the world, is you would see either the Western countries like Europe and U.S. flourish, and other areas like Asian countries not do so well. Or on the other hand, you would see Asian countries flourish, and then the U.S. would have a recession, and so on and so forth. But 2001 to 2007 was specifically fantastic for the entire world because everybody was doing very well during this period. And as I mentioned before, in summary, the Great Moderation, which is the period between 2001 to 2007, lasted longer and was more widespread than any other previous cyclical upswing. Okay, so then hit the financial crisis, and of course, the impact of financial crisis was grave in the U.S., but it is also true that with the information we had from the Great Depression, we were able to significantly curtail the negative impact of financial crisis on the U.S. markets. However, the way to curtail the negative impact for both U.S. and European countries was to flush the market with cash, and in doing so, a lot of countries saw a rapid increase in public debt levels. Okay, so the way they did that, the response to the financial crisis was to just essentially do all kinds of bailouts, and these bailouts were funded by debt. This, in turn, is what caused the trouble for the European area. Specifically, I'm talking about the sovereign debt crisis in the Eurozone. In the aftermath of the financial crisis, it has to be kept in mind that the sovereign debt crisis did not happen too far away from the financial crisis. So there's quite a bit of overlap between the financial crisis and the sovereign debt crisis, but we're going to discuss all of that now. So let's start by talking about the financial deregulation that led to the financial crisis. The deregulation phase started in the 1980s in the U.S. and it culminated with the repeal of Glass-Steagall Act of 1933. The repeal happened in 1999. What is the Glass-Steagall Act? Well, the Glass-Steagall Act was enacted in the aftermath of the Great Depression, which would be, as I mentioned, in 1933, partially because the act was designed to curtail banks' activities into the more boring business of accepting deposits and lending money. Okay, so in 1999, when this act was repealed, the first thing that happened, and it was expected to happen, this was by design, is banks started engaging in activities that they did not before. Specifically, what they did was they started borrowing money from across the world on a short-term basis and lending money in the long term. Now, you may ask, well, why is this that big of a deal? If you think about what a traditional bank does, is that it takes your deposits on the short term and then it lends that money in the long term. Now, what I'm saying here is, with the repeal of Glass-Steagall Act, banks started borrowing money in the short term and lending it in the long run. So you see the subtlety here. Instead of using your deposits, now they're using borrowed money. In some way, your deposits are still borrowed money, but at least you're a depositor as opposed to another financial institution. Which brings us to two specific mismatches or two specific risks. One is a maturity mismatch. Okay, and the maturity mismatch occurs between short-term borrowing and long-term investments. In that, if you are going to borrow on an overnight basis from other banks, and then you're going to lend it on the long-term basis, the problem is you're sort of hooked, aren't you? Until you get that amount of money in deposits, you're going to have to keep borrowing on an overnight basis or whatever that term is, which is generally very shorter, and keep repaying the next morning until you are able to raise your own money. So banks get hooked on being able to continuously renew short-term borrowing. Okay, so maturity mismatch is the first problem that occurs because banks borrow from one another. The second problem that occurs because banks borrow from one another is the currency mismatch. Okay, so what is the currency mismatch? Well, there was not enough money in the U.S. or among its U.S. banks, among U.S. banks for American banks to borrow from. So the pot that American banks had to borrow from, the American pot was too small. So they went ahead and borrowed from banks from other countries, so that specifically banks in Europe. Now, the problem is when you borrow from Europe, you borrow it in euros, you convert it in dollars, and then you do whatever you need to do in the US market. So you usually lend out that money, but you have to repay that back in euros. Okay? So if you were to repay that back in euros, now you have a currency mismatch or a currency risk associated with the money borrowed there as well. So those are the two risks that were introduced as a result of financial deregulation. Okay. Now, this is not necessarily, neither of these two risks are necessarily a problem as long as economic conditions are benign, in the sense that as long as other banks are willing to continue to lend you money on an overnight basis or very short-term basis, none of this is a problem. The problem begins when the other bank waits for a second and asks itself, wait, hang on a second, I don't want to keep giving you money on an overnight basis, makes no sense, let me stop. Well, now you have a problem, and we're going to discuss that problem going forward in the next few minutes. Okay? So what are the roots of the financial crisis? Well, the first challenge that caused the financial crisis is the U.S. government, specifically the Federal Reserve, was keen to increase home ownership, the so-called American dream in the U.S., right? And so what it did is it adopted measures that made it possible and very beneficial to lend to people that you wouldn't otherwise lend to. These are the subprime loans. You may have heard about these, but these are not necessarily desirable borrowers, okay? These are non-desirable borrowers originating, and the loans are given to them are called subprime loans. Why are they called subprime loans? Because prime borrowers are borrowers with high credit scores. Subprime borrowers are generally thought to be people who have a credit score of under 650 out of 800 or 850 or so. Anybody over 650 is considered a prime borrower, okay? So why did this happen? Well, this happened because America ran out of credit-worthy borrowers to lend to. Specifically, banks ran out of people with credit scores of over 650 to lend to. Now they're left with a pool of people that can't really afford to, or historically have shown negligence when it comes to repaying their debt. Okay, so as a result, subprime loans were made sort of quasi-legal. Okay, they were always legal, but regulators didn't allow it, and then regulators started allowing it. Okay, so now here's the kicker. The funny part is subprime loans were not allowed by regulation in Europe. Subprime mortgages only existed in the US. Europeans were significantly more conservative, and they said, well, hang on a second. If the borrower is not creditworthy, do not lend them money, right? But the problem still was the fact that in the aftermath of the financial crisis, people realized that this reasoning, people in Europe realized that this reasoning is inadequate because all financial institutions are linked with one another. So what I'm trying to say is that even if an American bank is lending money to a subprime borrower in the US, well, if it's borrowing the money that it lends to the subprime borrower from a European bank, in some ways, European bank is exposed to that risk, even though it's not directly making that loan, right? So that is exactly what happened, okay? And as the financial crisis hit, many of the European banks were hoping to weather the shock by concealing their own terrible situation from one another and their regulators. Specifically, remember we spoke about a few seconds ago that European banks were expected, or American banks had a maturity mismatch specific risk in that they were hooked onto the system of constantly borrowing money on a short-term basis so that they can continue lending money on a long-term basis. Well, they borrowed money from many European banks, and European banks wanted to hide their situation from their regulators and other banks. Because why? Because European banks were also borrowing from their European counterparts on a daily, overnight, or short-term basis. So, of course, if they expose their own financial situation to banks that they were borrowing from, then those European banks won't lend money to their European counterparts, right? And the whole system would come to a standstill. Here's the problem, though. If I'm a European bank and I know that I have toxic assets that I'm hiding from regulators and from the counterparty, which would be other European banks, then I have to assume that other bank is also doing the exact same thing. The other bank is also hiding its toxic assets from me and its regulators in Europe, right? This, as each bank claimed good health, they suspected, as I mentioned, all others are doing the same. This asymmetric information led to a widespread suspicion among European banks, and it halted mutual borrowing and lending. And we spoke about this. We spoke about this in chapter 18, where we talked about how the interbank markets froze. Specifically, we talked about how distressed countries were pretty much unable to borrow, or banks in distressed countries were unable to borrow from other banks in the Eurozone because everybody lost faith, and people lost a lot more faith in those distressed at banks in those distressed countries. Now, I don't know if you remember the chart, but if you were to go back at chapter 18's notes, and we have a video for this, there's a chart that shows that both distressed and non-distressed banks never really recovered when it comes to interbank lending. Okay, so that's the root of the financial crisis. Let's talk about what caused meltdown and then the rescue as well. Okay, so in 2007, as was the case in Europe, the US interbank market froze as well. It was exactly for the same reason. However, as we have already established, all banks globally, the big banks especially, are interconnected by a myriad of loans to one another. So this chain is as strong as its weakest link. Let me give you an example. The biggest bank in France is BNP Paribas, and the biggest bank in in Spain is Santander. What if Santander lent money to BNP Paribas, which in turn turned around, took that money and lent it to Bank of America, which in turn turned around, lent that money to JP Morgan Chase, who in turn turned around and lent that money to Lehman Brothers? Well, if Lehman fails and Lehman stops paying JP Morgan Chase, and we're talking about billions and billions of dollars, JP Morgan Chase turns around and tells Bank of America, Lehman didn't pay me, so I'm not really going to pay you. Bank of America turns around and tells BNP Paribas that it didn't get paid from JP Morgan Chase, so it's not going to pay BNP Paribas. BNP Paribas turns around and tells Santander, I didn't get paid, so I'm not going to pay you. Think about this, right? One bank did not pay the other bank, and 5 banks are affected as a result, right? So between September 2007 and 2008, many major banks failed as a result of this, including Lehman Brothers, right? And the moral stance among US regulators at first was, well, Lehman benefited from excessive risks for 4 or 5 years. And now it's paying the price from taking excessive risks. So the only people that should really lose money when we let Lehman fail is its shareholders and its creditors, right? They should pay the price because we didn't benefit from excessive risk taking, so why should we pay the cost? And by we, I really mean the taxpayer, right? But within a few hours of making that decision of allowing Lehman to fail, they realized that a ton of banks are linked to Lehman Brothers, and Lehman Brothers owed money to a ton of banks. And so eventually, pretty much every financial institution in the world was somehow connected to Lehman Brothers. So central banks around the world then scrambled to support the banking system. They offered cash, they bought toxic assets, they guaranteed unlimited deposits. And we spoke about this in the previous chapter, chapter 18. We talked about how Ireland began by offering unlimited deposit insurance for all deposits. As a result, Europeans started withdrawing money from their local banks and depositing it in Ireland. And then eventually other European countries were also required to offer deposit insurance, or else they'll keep seeing their deposits fly away. So one of the challenges that happened was banks were unable to honor their maturing borrowings, right? Let's go back to the example, the reverse example of how Lehman Brothers borrowed from JP Morgan Chase, JP Morgan Chase borrowed from Bank of America borrowed from BNP Paribas, borrowed from Santander. Well, in a situation where JP Morgan Chase is like, look, I know Bank of America, it's not your problem that Lehman didn't pay me, so let me pay you. But I don't have that much cash, because we are talking about billions and billions of dollars. Because if I did have that much cash, I would have lent it to someone, right? Because remember, the ethos in banking is you don't let cash sit around. You have to do something with it. So what if JP Morgan said, let me pay you by selling my securities for whatever price I can get, because the bottom line is I need to pay you. And we are in the middle of recession. Lehman just failed. Nobody's buying anybody else's assets. So we are going to have a fire sale of securities that I may have or other assets that I can sell to raise cash and give it to you. The problem is, as the fire sale began to take hold, the challenge we have is JP Morgan Chase lost a ton of money. It affected their profitability, and this in turn caused other banks to say, hey, JP Morgan Chase, you owe us money. You're not making money. You're losing money. I think you should give us our money back. That means JP Morgan Chase has to now sell even more stuff at a fire sale to pay to pay monies it owes to other banks as well. Anyway, so that's how the meltdown basically occurred, and that's what caused the rescues to take place. Okay. Now, banks have failed. Lehman Brothers has failed. Interbank lending has come to a standstill, and now the regulators and the central banks are trying to figure out, well, how do we avoid the new Great Depression? Okay. Governments especially hated being put in this position by banks to rescue them, especially because banks took excessive risks, and rescuing them would undoubtedly look like governments are supporting their excessive risk-taking behavior. But they soon realized, if you didn't rescue banks, how are you going to deploy monetary policy? Remember, we spoke about this in the previous chapter as well. Central banks deploy monetary policy through what are called primary dealers, which are 10 or 15 in the US, 10 or 15 largest banks in the US and in the world. And the Federal Reserve buys and sells securities to these 10 or 15 largest banks. But if they failed, who is it going to buy and sell security to? How do you deploy monetary policy? So the decision was made that if you were to incorporate any expansionary policy, it would have had to be carried out by banks. Therefore, these banks would be one would have to bail out these banks. Okay. But bailing out these banks implied that budget deficits went through the roof, right? For most countries, including the US, but smaller countries more so. Budget deficits, even for those countries that had historically paid excessive attention to fiscal discipline, like Ireland and Spain, those countries lost control of their budgets. Now, remember, we spoke about the entrance criteria, the Germany imposed entrance criteria to the single currency. One of them was was a budget deficit of no more than 3%, which would translate to a debt to GDP ratio of no more than 60%. We spoke about this a few chapters ago. Basically, if you wanted to enroll into the European Union and have euro as your currency, you can't have more than 3% of your more than 3% deficit and more than 60% debt to GDP ratio. Well, the problem is, and this happened in 1999, in the eve of adoption of euro. So think about this: in a matter of less than 10 years, countries went from being excessively conservative to excessively aggressive in accumulating a ton of debt, and Greece accumulated debt that soon. So we spoke about the financial crisis and what caused the financial crisis in brief in section 1 or stage 1. Let's now talk about stage 2, which delves into the public debt crisis in the Eurozone. Specifically, stage 2 only affected to a great extent the Eurozone, and so it's going to be an interesting study in how Eurozone got affected. So the legacy of the financial crisis was the great paradox. And what I mean by that is if the goal of regulators was to quickly return to growth in the aftermath of the financial crisis, they did that successfully. They were able to, financial crisis was deep, but it was relatively short. And countries were able to return to growth in a very short amount of time. The US was able to return to growth in less than 2 years. In European countries too, in the Eurozone as well, many countries were able to return to growth in less than 2 years. But as the US went growing, many countries in the Eurozone experienced what we now know as a double dip recession, which is a recession followed by a very brief period of growth, followed by a second recession, followed by extensive period of growth. So that's a double dip, 2 consecutive back-to-back recessions in a very short amount of time. So this was caused by what we call is the amazing paradox. And the paradox states that the financial crisis led governments to run considerable budget deficits in order to contain the recession, which worked. But paradoxically, these same deficits led financial markets to become worried about the sustainability of public finances, which in turn provoked a deep recession in the affected countries. Okay? So let's look at some data here. What I have here is 3 charts. We start by looking at the balance of payments, which is basically deficits for 2 groups of countries. The first are the distressed countries, and the second is the non-distressed countries. So distressed countries here, at least for the ones that I have data for, is Greece, Italy, Portugal, and Spain, colloquially known as PIGS, P-I-G-S, Portugal, Italy, Greece, and Spain. And so what we see here is if you look at fiscal discipline for a country like, for example, Italy, until it joined the European Union, it was very disciplined and it actually ran a budget surplus, a balance of payment surplus, okay? But what you're seeing after the financial crisis is all of these countries, especially Greece, Portugal, and Spain, experience severe budget shortfalls shortfalls, primarily because they had to raise money to bail out their own countries and their own economies. And so they ran monstrous deficits, and it caused, in some cases, in case of Greece at least, as you can see, between 2006 and 2008, they ran a deficit of very close to 15-17% of their GDP. And Italy was, or sorry, Portugal was not far behind too. If you look at this 2008, 2009, they're looking at 12-13% budget deficits. Italy was a little bit respectable, but still negative, greater than 3%, which was prescribed by the German's entrance criteria to the European Union in 1999. But given that we were in one of the deepest recessions since the Great Depression, Italy's deficit was respectable. But if you look at fast forward like 5-7 years after the recession, maybe in 2013, it was barely then these countries were able to run a budget surplus. What I do want you to pay attention to is this blue curve, which represents Greece. As you could see, Greece has pretty much, since the financial crisis, never ever been able to run a budget surplus, except maybe for two data points, which is right here and right here. So these are quarterly data points. So barring 2 quarters, it has never been able to, since 2008, so it's been 12 years, to generate a budget balance of payment surplus. Okay, so basically it keeps on adding debt. That's what I need to highlight here. Okay. Okay, now let's look at the non-distressed countries, which would be Germany, US, France, and overall Euro area. As you can see, a country like Germany, even at the heart of financial crisis, had a balance of payment surplus, or a current account balance surplus, which is pretty cool, right? Think about it. At the heart of the financial crisis, it did not have to originate debt to boost its economy when every other country was doing so. Now, if you look at someone like the United States, it has notoriously ran a balance of payment deficit for the entire period. And even after the financial crisis, we haven't really looked back and figured out a way to pay our bills. We have just continued to retain a balance of payment deficit. Okay, and then you look at the green line, which represents France. In the financial crisis, it had a respectable balance of payment deficit, given that it's a financial crisis. But what's of concern is, since the financial crisis, which should be about this time period, it has never really been able to generate a balance of payment surplus. So France is also in a slight trouble. Overall Euro area, in the last 8 or so years, it has done pretty well, seen here by the purple curve, primarily because majority of the Euro area is pretty much anchored by Greece. So Greece pulls this curve, Germany pulls this curve up, and France and Greece pulls this curve down. But Germany is just so big as an economy that it's able to pull the entire curve down despite the laggards. Okay. And the final chart is the aftermath of the financial crisis in terms of GDP growth. You could see the Euro area in blue line, and red line is the United States. And as you could see, the Euro area faced a deeper economic crisis as a result of financial crisis than the US did. But here's the double dip recession we spoke about briefly a second ago. As you could see, not only was there one recession, there's a second recession upon a brief recovery. This was the recovery period. But in the US, that is not the case. Since 2010, US has pretty much grown at a respectable rate. And so European Union had a double dip recession. So the theories that we discussed a few minutes ago are pretty much backed by data. Okay. Now let's talk about Greece, because Greece was pretty much the biggest troublemaker in the European region in the aftermath of the financial crisis. So right before the financial crisis in 2007, Greece public debt, this is the sum total of all budget deficits um, since the beginning of time. So that's the public debt. Sum total of Greek public debt as a percentage of GDP was already high at 105% of GDP right before the financial crisis. By 2009, it was as bad as 127% of GDP. So to put it in perspective, what does 100% of GDP mean? Well, it means that if it taxed 100% of everything that produced and sold in Greece and took that money to pay its debt, it still would not have enough money. So let me say that one more time. If the Greek government taxed 100% of everything that's produced and sold within Greece, it won't have enough money to pay um, the debt back. Put differently, if you were to buy Greek olives and 100% of proceeds went to repaying the debt, and then you went to go tourism, you stayed at a hotel, 100% of what you paid the hotel was collected by the Greek government as tax. And let's say you did a cruise within Greece, 100% of of the money that you paid to the cruise liner, if it was collected by the government as tax, and all of that money in that sense was then used to pay the debt, it still would not have enough money. That's how much debt it had as a country. That's how much debt the government had. It jumped to 127%, which in turn caused market participants. When Greek borrowed money, it had to borrow from someone. So these financial market participants became concerned, and they started realizing that, wait a second, how on earth is Greece going to pay this money back? And because we think it's not going to be able to pay the money back, the only way to lend them even more money is to charge a very high interest rate. Now, historically, in the past, when governments have found it impossible to borrow from markets, or they have found it difficult because not only nobody wants to lend, but those people who want to lend charge a punitive interest rate, they usually go to IMF to borrow money, right? So IMF, in some ways, for countries, is a lender of last resort, just like the Federal Reserve is the lender of last resort for US-based banks. When nobody wants to lend to these banks, they go to the Federal Reserve and they borrow from the discount window. Okay, so in May 2010, so Greece sought money from IMF. In May 2010, IMF, European Union, and the European Central Bank, also known colloquially as Troika, because there are three, announced a joint facility to lend money to Greece. They lent 110 billion euros to Greece. But every time you go to IMF, or every time you go to a government entity or sort of a government bank, they come with conditions. They're not going to just lend you money because they realize that if nobody else wants to lend you money, there must be a reason behind that. And they need to make sure that you pay that money back. So the conditions primarily were Greece had to make very, very drastic social benefits cut and increases in taxes, which is ironic because while Greece is in the middle of one of its deepest recessions, if you increase taxes and if you cut social security payments like pension to older people and so on and so forth, and you increase the retirement age and so on and so forth, what's going to end up happening are public salaries. If you reduce public salaries, government salaries drastically, what's going to happen is people are going to spend less money, and the recession is going to get even deeper. So at a time when Greece should not have had to cut any of the benefits, public spending, or or increase taxes, IMF wanted it to do exactly that. As a result, even though it borrowed $110 billion to stay afloat in 2010, it had to borrow another $130 billion with a B in 2012 because, as I mentioned, these draconian measures had drastic impact on Greek economy. Let's look at a chart that shows public debt as a percentage of GDP for distressed countries. Remember, in the previous charts, we looked at deficit. And this chart, we looked at debt. We're looking at debt. So the difference between debt and deficit is that deficit is year over year increase year over year imbalances in government revenue versus government expenditure. So when expenditure exceeds revenue, it has to borrow money to pay their bills essentially. And as I mentioned, public debt is the sum total of all debt over its life. Um, in in distressed countries, here you could see Greece started out with a ton of discipline until the financial crisis. As you could see, its debt level was pretty respectable, below 60% of GDP. But come financial crisis, it just lost control of the picture, and it has never really gone down. Greece debt level, even today, we are right now in 2020. This data is as of 2018. Greek debt level is 180% of its GDP. Think about that for a second. If it taxed everything that's produced and sold within Greece at 100%, there wouldn't be enough money for Greece to pay its debt. You look at other countries as well. You look at Italy, Portugal, Spain. They all experienced a significant and sustained increase in debt level. But the good part is these four countries, Italy, Portugal, Spain, and Greece, as you could see, at a certain point. So for Greece, for Ireland, that point was 2013. They actually started paying their debt back, and the direction is going down for all of these four countries. Not the case with Greece. It just never goes down for Greece. That's why Greece crisis is such a big deal. Okay. Now let's compare the distressed countries with non-distressed countries. So here we have United States, France, UK, Germany, and Japan and their debt levels. Well, Japan was always notorious. It always had high levels of debt relative to GDP. Was a special case scenario. Even in 1996, actually at the formation of the European Union, you can see here, debt level was already 140% of GDP. So the question is, why does this not blow up? Why does Japan have so much debt and it's not that big of a deal, but Greece has relatively lesser debt and it's sincerely a bigger deal? Well, the answer to that is majority of the Japanese debt is owned by Japanese people, and majority of the Greek debt is owned by everybody else but the Greeks. So the problem is, if you're a foreign investor in Greece, then Greece becomes more risky. But since most of the debt in Japan is owned by Japanese people, it's not as risky. The same stands true for United States. Significant majority of the public debt in US is owned by American banks and financial institutions. So even though we are over 100%, close to 140% of GDP, it's not that big of a deal. Now, if you look at other countries such as Germany, France, and UK, Germany is truly outstanding because not only did it increase its debt level, eventually its debt level started declining, and now it's as little as 70% of its GDP. So it is my understanding that German constitution does not allow for an imbalance. In other words, by constitution, Germany cannot spend more money than it collects in tax revenue. Okay. Now let's talk about the contagion inside the European Union or the Eurozone within this period. So we already spoke about how in May 2010, Greece borrowed not 100 but $110 billion. $110 billion. What also happened is instead of assuaging fears that okay, things must calm down now because Greece has been bailed out, it got the money. What ended up happening is financial markets started focusing on other countries. It said, wait, hang on a second. Well, Greece is out of trouble, but what about other countries? What about countries like Ireland? We don't think Ireland is financially stable. Let's charge them a very punitive interest rate. As a result, Ireland also in November 2010 had to borrow $85 billion. Then in May 2011, people moved on to Portugal and said, well, we don't think Portugal is safe either. So Portugal had to borrow $78 billion. Then once again, a repeat for Greece. In 2012, it had to borrow $130 billion, followed by Spain in 2012, $100 billion, And Cyprus, very small country, had to borrow in 2013 $10 billion. Okay. So basically, this what this picture shows is it started out with Greece, and bailing out Greece had the exact opposite effect of what was desired by the IMF. Instead of calming markets, it riled the markets up even more because they started focusing on other economies, and in turn, those economies had to borrow more money. Okay, so there's some troubling characteristics within the eurozone as far as this contagion is concerned, because no other developed country elsewhere outside of the eurozone faced debt crisis that the European Union faced, especially a country like Japan. You'd think Japan would get in trouble, but it did. So, what are the main interpretations of the contagion? Okay, number one is indebtedness. So, one of the challenges that people can't wrap their arms around is indebtedness in and of itself can't explain why these countries, which is Greece, Ireland, Portugal, Greece, Spain, Greece, Ireland, Portugal, Greece, one more time, Spain, and Cyprus had to borrow tons and tons of money, and other countries did. Especially because if you were to group countries within these, if you were to split these two or three countries and split these six countries into two buckets, and you started with Ireland, the truth is Ireland was fiscally very disciplined until the financial crisis. It was only after the financial crisis that its public finances deteriorated, and that too happened because it had to bail out banks. On the other hand, Portugal was always not disciplined. Portugal was always in trouble. It always had a poor record of fiscal discipline. And therefore low growth prospects. So the question is, why did Ireland have to face the brunt of the financial markets just like Portugal did? In other words, Portugal deserved it, Ireland didn't, but why did this happen? And we could see that. And if you were to look at if you were to look at Ireland until the financial crisis, they had very low debt levels right here. And on the other hand, so this is Ireland right here, very low debt levels. On the other hand, someone like Portugal, they always had higher debt levels, yet Ireland had to suffer. The question is, why did that happen? So the answer to that is, I think there was the crisis was caused by an existence of multiple equilibria. It just so happened, and what that means essentially is, it just so happened is once Greece was bailed out, people said, okay, well now let's look at other countries. Which other country we think is gonna get in trouble? So it just happened that these investors started paying attention to, in addition to Greece, also Ireland and Portugal. With equal vengeance, even though, as we mentioned, Ireland was much more disciplined than Portugal. So that was one of the characteristics of the contagion. The second characteristic of the contagion, as people try to sort of unravel what happened, is there was no lender of last resort. If you were an individual country that did not take part in the monetary union, then you would have your own central bank. And usually what happens is, if you have your own central bank, then the central bank and the government would say, we are willing to do whatever it takes to calm the markets, the financial markets specifically. And what that basically means is we're going to bail out whoever we want and do whatever it takes in terms of printing money. ECB, European Central Bank, however, was more distant from most member countries. In fact, the Eurozone governments really did oppose large-scale purchases of public bonds by the Euro system. Basically, Eurozone governments from non-distressed countries like France, UK, and Germany vetoed ECB's ability to buy, say, Greek bonds, on behalf of the Euro system, or, for example, Irish bonds, or bail any of the Irish, bail the Irish or the Greek or the Portuguese government out. Because they said, their thought process is, this creates a situation of moral hazard. In that, countries that have excessive budget deficit before the financial crisis did so out of choice. And so by bailing them out, you're creating a moral hazard problem in that the countries that were fiscally disciplined now have to pay the bills. Okay? The third component of the contagion was competitiveness. Okay, so we have spoken about this throughout this class, and it's an important concept to keep in mind that usually when there is a recession, the country becomes less competitive, its exchange rate tanks, and slowly and steadily, because its exchange rates tank, people start to buy more of their foreigners start to buy more of their goods, so exports increase, and that in turn boosts the economy. Okay, that in turn boosts the economy. But in case of economic area like Eurozone, where there is a single currency and a single unified central bank, exchange rates were never allowed to drop, right, or to depreciate, primarily because it was non-distressed countries and distressed countries to an extent were competing against one another. Specifically, if the interest rates depreciated, then countries like Germany, France, UK would face higher inflation, and if the exchange rates remained at the level that they were, then countries like Greece, Ireland, Portugal, and Spain would continue to remain non-competitive. So competitiveness was another issue that caused this contagion. The final takeaway from the contagion was policymaking. Specifically, the Greece crisis had spooked financial markets across the Eurozone. And as I mentioned before, people thought that bailing Greece out would calm the fears. In fact, the opposite happened. The conditions imposed on bailing Greece out were so stringent that people realized that it puts Greece in a precarious situation where it's never going to be able to pay off that debt. And as a result, spreads between Greek bonds and German bonds continue to rise even after deciding to bail out Greece, right? Because basically, not only spreads between Greek bonds and German bonds, but spreads between Greek bonds and other countries as well started to rise. The poor performing countries with higher debt levels, distressed countries, also started to rise. So here's a chart that shows the differences between long-term government bonds, which is essentially 10 years, between a given country's bond and the German bonds. So if I were to zoom in here, you could see, of course, the light blue curve has to be Greece. As you could see, the difference between 10-year bond in Greece, interest rate on 10-year bond in Greece, and interest rate on 10-year bond in Germany was 27% right here at the peak. But you look at this sort of light blue line, and that line belongs to Portugal here as well. The spread is over 10%, right? So if you were to borrow money in Greece, if you were to lend money to Greece versus Germany versus lending the same money to Portugal, then as an investor, what you're basically saying in 2012 is Portugal has to pay me 10% more. That's the only way I'll lend you that money. The same happened to this purple line, which represents Ireland, right? Over 5% spread. And then there's these other countries as well that have negligible spread. But the truth is, from a point where you had this convergence during the Great Moderation period from the adoption of Euro in 1999 to 2007, to a period where you have a spread gap of as much as 30%, 25%, that's a huge deal. And if you think about this, I guess the financial markets were right in this point in policymaking issue, is that look at this spread. The spread is not subsiding even after the financial crisis. Even after 12 years after the financial crisis, we're in 2020, and the spread between Greek bonds and German bonds are still considerable. At least in 2015, it used to be over 10%. It has finally come down, but we're at the heart of now the coronavirus-related crisis. So we'll see how that impacts. I suspect that what you're going to see is Greece was once again going to go like this. Maybe not that high, but it's going to go higher as compared to German bonds. Okay? All right. Now let's summarize this discussion by explaining each of the crises in each of the countries sort of individually, right? So financial, as I discussed before, financial markets doubted that Greece and Portugal could continue adding more debt without eventually defaulting. Okay, so financial markets doubted that Greece and Portugal would continue adding more debt without eventually defaulting, and this doubt on Greece first came on because the newly elected government in Greece sort of said that the previous government had defrauded all the investors and they have significantly more debt and less revenue than they told the general public. Basically, they said Greek books at a country level were cooked and they basically didn't collect as much tax revenue as they told people they did. As a result, of this lie, financial markets realize, well, if you can pretty much trust nothing, right? You can trust nothing from the Greek government. Their budgets are all trash. Their financial data is all trash and untruthful. So they started charging an excessive premium. On the other hand, Ireland and Spain displayed a pretty good restraint in terms of their debt levels and in terms of their deficits in the years prior to the financial crisis. However, their trouble started because they had to bail out their large banks and they had to borrow money, excessive money, to bail these banks out. Okay. And then if you were to look at Ireland in and of itself, outside of Spain, the markets trusted that the Irish government is going to eventually roll back the sudden increase in debt. And why wouldn't it? Because historically, as we saw in previous chart, where is it? As you saw right here in this chart, that shows the public debt as a percentage of GDP, Ireland was the most disciplined. Hang on. Ireland was a country with the most discipline among the distressed countries when it started out. Here's Ireland once again, right here. Ireland was a country with the most fiscal discipline, and so markets believe that it's gonna continue to remain fiscally smart in terms of repaying their debt. But then the problem started with the Irish government having to guarantee 100% unlimited bank deposits and bank liabilities in 2008. That's a huge deal. What they're basically saying is if any of the Irish banks failed, they'll make the depositor whole. And the cost of this guarantee at that point in 2008 as an investor was unknown, right? Because can you imagine how much deposits are there in the banks in the US? Actually, there's no need to imagine. The truth is there should be about 10 plus trillion dollars worth of deposits in banks today. So the question is, and I would say it's probably even closer to $15 trillion. But I would say if you're an investor and your banks and all the banks in the US says we're going to insure 100% of the deposits, well, how much of that 15 trillion you may actually have to pay out, right? Nobody knows. It could be 2 trillion, it could be 10 trillion. So that's a problem. And the financial markets picked up on that problem and started punishing the Irish bond market, okay, or the Irish bonds. Italy, on the other hand, had managed to stabilize its debt at 110% of GDP. And the way it did that is by relying on expansionary fiscal policy that were designed to contain the recession. But the problem is, Italy did, even though it put in place steps to grow fiscally, it wasn't, and that in turn made it difficult to repay the debt. That in turn made it difficult to repay the debt. Partially because all fiscal measures usually take time, right? Like if you're in the middle of financial crisis and you say start out with lowering taxes to increase businesses or whatever it is that you're going to do to improve employment and income, the problem is it takes 3, 4, 5 years before anybody sees the effect. And by that time, the markets had already decided that it's too late. Okay. Finally, France had poor fiscal discipline, especially when compared to Germany, but its debt level was relatively moderate. It was not that big of a deal as compared to other countries. And then Germany, on the other hand, of course, had a super stellar and continues to have a stellar reputation of a fiscally disciplined country, very disciplined country. As I mentioned, with the 2009 adoption of zero budget rules. Basically, by constitution, Germany cannot have a budget deficit because it's not allowed to spend more money than it collects in tax revenue. Okay. Now, we don't know if France and Germany could have handled additional deterioration in circumstances, but so we talked about the financial crisis and the resultant sovereign debt crisis in the European Union. Let's now talk about the policy responses to the second piece of this, which is the sovereign debt crisis. So, as far as the financial markets are concerned, and the responsive policy on financial markets, two things happened. Number one was that the financial markets were super worried that governments may not pay their bills, they may leave the euro system, or their banks would fail. And that caused panic within the investor community in the financial market. And their immediate response, as we saw, was divergence in interest rates that they sought from bonds and debt issued by some of the weaker European Union countries. The second thing that happened is, and this is true no matter where this is, but financial markets really do hate uncertainty. They don't like disclarity. They don't like weak economic response or weak governmental response. And that is exactly what happened in the aftermath of the financial crisis. So, half-hearted response from the governmental organizations, not only at the national level but also at the supranational level that managed the Eurozone as a whole, was not appreciated by the financial market. So how did they respond? Well, they created something called the European Financial Stability Facility in May 2010, at the time of the Greek bailout. And the idea, the individual governments went to the news media and said that the ESFS has the ability bailout capacity of $440 billion, and then there's an additional $60 billion from the European Commission and $250 billion from IMF, or the International Monetary Fund. However, once the announcement was made, investors were quick to realize that it can't be possible that the European Commission has committed to $60 billion in bailout funds, because it exceeds the amount of money its budget has. As we mentioned before, a big chunk of the European Commission budget goes towards the common agricultural policy, and there's very little maneuvering ability left within the budget after the money for common agricultural policy is spent. So people realize that there's no way European Commission can come up with $60 billion. That was number one. Number two is there was an egg on the face of various governments, because they had to do an about face, and really investors learned that the $440 billion initially billion euros initially guaranteed by the ESFS was really 250 billion euros. And finally, investors also learned that the 250 billion euros that were promised by the IMF were not really committed by the IMF. So in other words, IMF didn't provide any explicit commitment saying, yes, we're going to give, we're going to provide a facility of 250 billion euros to bail out various European economies. Okay, so that was the response to various half-hearted policies by government entities within the European Union. Now let's talk about the fiscal policy strategy. Okay, so the response to the Greek crisis, which was, if you remember, the Troika bailed out Greece, the IMF, European Commission, and the European Central Bank bailed out Greece, but it imposed on Greece very strict conditions, austerity conditions, and that became the template for pretty much all the other future bailouts. Specifically, conditions include a significant reduction in public expenditure, increases in taxes. And so how would you achieve reduction in public expenditure? Well, you would reduce the size of the civil service, so fire government employees, lower their salaries, privatize state-owned companies, improve tax collection, so make it more efficient, and eliminate sort of underground professions where people deal with cash, and finally pension reforms as well, which essentially means increase the retirement and lower the pension amount. So those extremely stringent criteria became template for bailing out pretty much any other economy. However, many investors realized fiscal restraint in the face of an already monstrous recession. Once again, this was the biggest recession since the Great Depression. Didn't make any sense because they realized that even if the borrowing nations agreed to these extremely austere terms, tax revenue would basically decline because it would because of the recession, people are already unemployed. Furthermore, you're reducing the civil service, you're lowering their salaries, and you're lowering the pensions. So people are going to spend less money, and as a result, people are going to pay less taxes. So in the grand scheme of things, investors realize that these countries will never be able to pay off their loans given to them by the Troika. And more importantly, as a result of that, debt would keep increasing because they'd have to borrow even more money to just service the debt that they had previously taken out. And this would defeat the very purpose of the policy to bail out individual economies. Okay, let's look at some data here. So the multi-year IMF real GDP growth forecast for Greece and Ireland at the onset of the bailout program, which was about in 2008, 9, 10. What I'm trying to say is in 2009, IMF made projections on Greece's growth pattern, real GDP growth for the future. So what it showed is in 2009, as you can see, the dotted line shows us, and here's the dotted line. The dotted line right here shows us that Greece was projected to grow pretty decently. Anything over 100 is a decent growth amount. But then after getting the funds and agreeing to the austerity measures by the IMF revised its growth rate in 2010 to slightly lower. Basically, it said upon taking money in 2010, for the next 4 years, it's going to have a negative growth rate. But then they once again revised this in 2011, and growth was lowered even more. 2012, new estimates show that growth is going to lower even more or decrease even more. 2013 and 14 is worst case scenario, where even 5 years after taking the bailout money, Greece was expected to only be at 75% of its GDP level that it had achieved in 2000 before the financial crisis in 2008. The story was slightly different in Ireland. Every estimate, so in Ireland, the 2009 estimate was the worst, and every estimate after that in 2010, 11, 12, 13, and 14 for future growth was significantly better. Of course, the 2014 is not really an estimate, it was the actual growth projection. So basically, Ireland came out unscathed, and it had a very impressive story to tell in terms of getting bailed out by the Troika. But Greece did not have equal luck or experience. One of the other points of the fiscal policy strategy was people compared how the three countries responded, or the three economic areas, US, Eurozone, and UK responded to the financial crisis, and especially in the middle of very weak economic environment. And when I say how did they respond to it, the idea is what did the governments do? And so if you look at the budget balances between 2007 to 2013, it shows the average budget balances. It shows an average balance of negative nearly 7% for UK for those 7 years, a balance of nearly negative 8% for US, but Eurozone only had a balance of negative 4%. Now, of course, intuitively, this sounds like this is a good thing that European Union is being more conservative in issuing debt during the financial crisis. But as we have discussed before, fiscal policy and monetary policy are usually counter-cyclical. In other words, in good times, government spends less money, and in bad times, when everybody's lost their jobs, government spends more money to create those jobs. So the question that the financial markets asked whether this whether the fiscal policy strategy was good enough, especially comparing Eurozone's response to the response of US and UK, which was significantly more comprehensive, as evidenced by a larger average debt or larger average deficit. Okay. Now let's talk about the bailout institutions. So we already discussed EFSF, I can never say it right, was created in the face of bailing out Greece, and eventually led to the bailouts of Ireland and Portugal and Spain as well. So yes, EFSF bailed out Ireland, Portugal, and Spain, Greece, Ireland, and Portugal. But this was really considered a temporary arrangement just to bail these three countries out, and it had a limited lending capacity, as I mentioned, was a 250 billion euros, which people thought initially was 440 billion euros, and its mandate was only to directly bail out countries and not necessarily bail out companies within those countries. So no bailouts for banks, only bailouts for countries. And also its mandate was it could not purchase existing debt, right? So it can't purchase existing debt. It can only force these countries to issue newer debt, okay? And as the crisis worsened, because remember, we spoke about this unusual response where basically it was a counter-cyclical response. At a time when there was a recession, an ideal response would be the government spending a ton more money and not austeriting at all and creating jobs, because clearly the economy came to a standstill. Instead, the response was the exact opposite, where more restrictions were imposed on these three economies, these three distressed economies. Anyway, as the crisis worsened, the Euro system replaced EFSF with a bigger and more permanent fund called the European Stability Mechanism in 2012. So EFSF was formed in 2010-ish. It was replaced by European Stability Mechanism in 2012. It had a lending capacity of 500 billion euros, and it belonged to the Eurozone countries, which contributed to the capital, starting with about $80 billion, but the mandate was it can be increased to about 700 billion euros, 80 billion euros, and could be increased to 700 billion euros if there is a need. Now the EFSF, as I mentioned before, contributed to the bailout of the first wave of distressed countries, which is Greece, Ireland, and Portugal, and ESM contributed to the bailout of Spain and Portugal, or Spain and Cyprus. Okay. Moving on, let's discuss the monetary policy response. We talked about the fiscal policy response. We talked about the financial market response. Let's talk about the monetary policy response. So like the Federal Reserve, Bank of England and the Euro system reduced its interest rate to near zero. However, people or financial markets were not too happy with the pace at which the Euro system reduced its interest rate to zero, and they rendered the action controversial. Growth in UK and US was especially stronger, but EU still faced an inflation of only 0.5%. So people argued, well, if you're facing an inflation of only 0.5%, then why would you not take on more aggressive measures by even more aggressively reducing the interest rates in a shorter amount of time to near zero? Because back then, remember, back then we didn't have interest rates that were less than zero. That was only in the recent past, in the last 5-7 years. So the question was, if the expected inflation in the Euro system was only 0.5%, then the financial markets argued, why couldn't the Euro system or the European Central Bank reduce the interest rates even more aggressively? Okay, but then of course the euro system had to remind that they only have single mandate, unlike the US where the mandate is full employment and price stability. The only mandate the euro system has is price stability, and that is not negotiable. They also reminded the investors that if you think about it, sovereign debt crisis where countries borrowed way too much money was created by extremely low interest rates to begin with. So they wanted to make sure that they're very cautious in their approach going forward. The euro system was okay. To deal with the freezing interbank market, which we discussed a little bit earlier in the chapter, European Central Bank undertook the ability to, or displayed its ability to lend to the banks directly rather than through the financial markets. Now, what banks wanted to do was to basically amass a ton of liquidity. Liquidity was king, and it always is during distress times, right? Banks want to conserve as much cash as they possibly can. They don't like lending out money. They just want to sit on a pile of cash. So when economy gets better, they can invest that money, or in case of any issues, they can use that money to pay off their existing or existing people they've borrowed from. So to pay those entities off, their counterparties, they really want a ton of liquidity. But within a few weeks of to sort of satisfy this urge of these banks, not only in the U.S. but also in the European Union, European central banks' balance sheets grew by 40%. But on the other hand, the Federal Reserves and the Central Bank of England, which is Bank of England, doubled within the same period of time. So once again, the policy response, monetary policy response from the euro system was a little bit weak in that the Federal Reserve and the Bank of England did a lot more than the euro system did. In 2011, when all of these three very important central banks realized that flooding banks with enough cash to double their own balance sheet is not enough, they flooded the banks with even more cash, and the Fed's balance sheet pretty much quadrupled from before the financial crisis. But that was not the case with the euro system. Okay. Once again, the European Central Bank had to once again remind everybody that price stability is its main priority, and it's not necessarily acting as a lender of last resort, which the Federal Reserve is required to do. It said that to maintain price stability and to ensure that there's no deflationary pressures, it had to pump the economy with excessive money, and they did so under that guise and not necessarily acting as a lender of last resort. However, countries in the north, so these would be pretty much the non-Mediterranean countries or the non-distressed countries, they were not under the same economic pressures as the southern countries, and therefore, of course, they were not as supportive of central bank interventions because what they realize is, once again, we've discussed this point many times before, that this can result in a moral hazard issue where these countries in the south, are forever incentivized to take on excessive spending and very unruly fiscal policies because they now know that northern countries will always quote unquote bail them out, right? So this divergence of opinion where the north did not want to be extravagant, but the south really needed that help, constrained the euro system, and homogeneity of preference was found missing. And if you remember correctly, homogeneity of preference was one of the criteria of optimum currency area. The idea was, do all countries that become member of the currency area eventually develop homogeneous preferences in that everybody agrees to either bail everybody else out or everybody disagrees to bail everybody else out. So that's the homogeneity of preference. Here it was found missing. Okay. Finally, the crisis worsened in July 2012, and ECB had to announce because the financial markets had no faith in in ECB's lackluster response thus far. So Mario Draghi had to announce Mario Draghi was the chairman of ECB, had to announce that ECB is now ready to do whatever it takes to preserve the euro. By September 2012, uh, they also announced that an open market transaction program was launched, which is pretty similar to how Federal Reserve operates. And these two drastic steps, calmed the markets down finally, because people realize that the European Central Bank is going to truly do whatever it takes to preserve the euro. If that means bailing out the troubled countries, then that's what they're going to do. And so the response by the financial markets remember we spoke about the spreads between the German bonds and and distressed countries' 10-year bonds. Those spreads were declined, and we may be able to go up and see if we still have the chart. Let's see. Maybe it was the previous chapter. Let's see. Nope, it's right here. So if you see in 2012, right here, Mario Draghi said the ECB is willing to do whatever it takes, and look at the spreads between Greek 10-year bonds and German 10-year bonds. Fell dramatically, the same here, and the same in these countries. You see there's a peak at about 2012. We said September 2012 is when there's a significant decline in those spreads. So we could now confirm that with data as well. So this is confirmed with data, right? Now let's look at the next section, which is public debt, banks and the public debt. Okay. And so specifically here, we're talking about aptly named a diabolic loop. So why is this a diabolic loop? Let's think about it. So if you were to summarize everything that led to the financial crisis and then the sovereign debt crisis, this is what you'd get. Excessive bank lending led to overheating of the housing market, right? And when the bubble burst, eventually the prices fell rapidly. Okay. As prices fell, many borrowers realized that this makes no sense, that they're still paying for a home that cost them twice as much, but if they were to sell it today, it'll cost them half as much. So in other words, if you bought a home for €500,000 and you're paying your debt as if it was worth €500,000, except if you were to sell it today, you're probably going to get €200,000 for it. So it makes no sense for you to service that debt, and so people stop servicing that debt. But the problem is, when banks don't get their loans back, the money that they have lent out back, they can't pay other people back, right? Specifically, they can't pay the depositors back because it's not their own money that they're investing or lending, it's the depositors' money. So many governments had to inject cash into their banks in 2008. And we know this not to be true not only in the US, but also in Europe. In 2009, though, the recession made it even more difficult for borrowers, because clearly, as fewer and fewer people continued paying for their homes, home values continued its precipitous drop. And now they're once again in 2009, even more borrowers are put in the precarious position of whether they should continue paying their bills. The last problem was the sovereign debt crisis, and here's the funny part, people don't realize a significant portion of sovereign debt, which is your own government's debt, is generally owned by banks. And so on the one hand, banks are already suffering from their borrowers not paying them back. On the other hand, all the sovereign bonds issued by various countries are pretty much starting to lose steam as well, and their prices are declining rapidly, right? So not only are banks getting squeezed on the one side from borrowers that are not paying back their loans, but also the non-loan assets that banks own, which would be sovereign debt, is also losing its value rapidly. Now the challenge here for governments is that governments realize that the only way they can pour money into the economy is through these intermediaries, or primary dealers, or also known as large banks. So they realize that they have to bail these banks out, because that's the only way any fiscal policy, or even any monetary policy can be made effective. So this outcome was a weird diabolic loop where basically governments had to bail out their banks because the banks held on to sovereign debt, which was losing value. And to bail out those banks, government had to issue even more debt. That debt, in turn, was once again bought by the same banks. So here the loop is that the banks were encouraged to buy public debt as a means of upholding their value. In the sense that if I'm Greece, the government of Greece, and if I'm trying to bail out my banks, and for that I issue debt to, put money into these banks, I'm going to encourage my own banks to buy that debt, because what's going to happen is the more the people buy the debt, the higher the value it is able to retain, right? Just like simple demand and supply. If more people want something, it's going to become more expensive. If fewer people want something, its price is going to tank. So this diabolic loop thus ensnared basically banks and government into a dangerous embrace where one supports the other, and then in turn the other has to support the first one again. Now, at any moment, the financial markets realize that people may stop funding the government debt, and as a result, there would be a strong drop in bond prices. This in turn would once again create a bank crisis, right? Because remember, who are the owners of these bonds? It's primarily the banks, right? On the other hand, the markets also thought that the banks are doomed and the banks would need more recapitalization, which in turn would create even more government debt, right? So in other words, on the one hand, the sovereign debt owned by banks would be worthless, and therefore this would create a bank crisis. On the other hand, because its borrowers were not paying their bills, they would need more money, and the government would have to issue more debt. So this is basically the diabolical loop. So in response to that, in the US, the government organized a series of what are now famously known as stress tests. The basic idea behind a stress test is to ask banks to shock its balance sheet for unusual economic outcomes. So basically, the idea is to say, look, of course you're doing great right now when everything is great, but what if theoretically things were to turn sour tomorrow? Does your bank have a capacity to independently survive without any government bailout? Now, these tests were very strict, and many banks were found to be very fragile, and many banks were to be found not being able to sort of stand on their own during the next crisis, and they were asked to increase their capital levels, right? Basically, think of capital as a down payment to your house. If you go get a home loan, then the bank is going to say, well, sure, I can lend you money for 100% of the home, but what's stopping you from just waking up one day and say, look, I'm going through hard times, I'm going through a divorce, I'm out, I don't want this home anymore. And then now I'm stuck with a home that I need to figure out what to do with, or at least maintain until I can sell it. And I don't want to be in the business of maintaining homes. I'm in the business of lending money out. So the bank says, well, you need to have what's called skin in the game. And so why don't you put 20% down, and then I'll put 80%. I'll give you a loan in the amount of 80%. The idea being, if you put 20% down, it shows the bank that you were smart enough to save money, so you're going to be smart enough to pay your bills because you don't want to lose your 20%. Similarly, in this instance too, stress test says if you cannot survive a stressful scenario, as the name suggests, economic scenario, then you need to have more quote unquote skin in the game, which is also known as higher levels of capital. So many U.S. banks and European banks with American subsidiaries like Santander is in the U.S., HSBC is in the U.S., BNP Paribas does businesses, Bank of the West, and so on and so forth. Many of these large US banks and European banks failed the stress test and they were found unfit. Well, you don't want to lose your ability to business in the financial capital of the world, which is the US. So these banks immediately complied with the stringent requirements put forth by the Federal Reserve and the Office of the Comptroller of the Currency in terms of higher levels of capital. Eurozone also tried to do something like this, but once again, the response was haphazard, and financial markets did not like the stress test. Specifically, the test was carried out in 2010, but it did not include any simulation for sovereign debt crisis. In other words, they were stressed, but they were not stressed enough because the way stress tests work, just real quick, some background, is usually there are scenarios that are provided to banks, and they're based on those scenarios. You're supposed to identify whether you can survive that scenario. So the two scenarios in the U.S. are called adverse and severely adverse scenarios. So in Europe, a severely adverse scenario would be, well, what if you owned Greek bonds and the Greek government stopped paying its bills? What would happen to your balance sheet then? So basically in 2010, investors did not like the stress test imposed on these banks because it did not include a simulated debt crisis. Despite that, the result identified that 6 large banks were failing the stress test, and therefore they needed recapitalization. But once again, investors did not see these tests as adequate. They wanted more stringent measures, and had they imposed more stringent theoretical scenarios, they would have found that a lot more banks did not pass the stress test. The second test was carried out a year later, and this time it included a sovereign debt default of only 15%. What that means is 15% of all your bonds would stop basically paying. However, investors once again realized, when I say investors, I mean financial markets, once again realized that 15% is too little because Greek debt was already was already selling at half its value. So in other words, if 50% of your debt if you own Greek debt, and the stress scenario said, well, what if 15% of that debt start paying? But in reality, the truth was 50% of Greek debt had already stopped paying. So once again, Europe failed at imposing severe enough stress tests to regain confidence from the financial markets. Okay. So the last part of this chapter talks about what did we learn from this crisis. Okay. So section 1 in this last section is about fiscal discipline and public debt. So the need for fiscal discipline was immediately recognized. Well, in fact, that was the first thing that was learned, because everybody started wondering, how did we get here? How was Greece put in such a precarious situation that with a small enough shock, their debt levels shot through the roof, right? And today they're standing at 180% of GDP. So the problem, though, is by the time fiscal discipline was forcefully imposed on these undisciplined countries, it was deemed contradictory in that it was designed to impose discipline on national governments, but the problem is you can't allow countries to have their own ability to spend money, which is fiscal sovereignty, and on the one hand, and on the other hand, ask them to be fiscally more conservative. That's like basically, basically giving a robber, keys to your homes and saying, well, make sure you don't steal anything, right? Well, that's not going to happen. You have to take away the keys. So that was the first lesson that was learned from the financial crisis. So a better solution to this would be creation of a fiscal union, which would then necessitate a central authority that would basically have its own resources, and it would have some power over national governments. So this, if you think about it, this is very similar to what the United States does. Right now, we're in the middle of coronavirus crisis, and basically the federal government, the state governments expect federal government to provide them with the resources to buy the personal protective equipment for the first responders, but also, more importantly, also have funds for tasks and so on and so forth, because clearly state governments don't have their own money to take on such a massive undertaking. So one of the lessons learned from the financial crisis and the ensuing sovereign debt crisis is that they needed similar structure to that of the United States. A more disquieting legacy of the financial crisis was a significant increase in public debt as a result of the crisis. But what's the problem with high levels of public debt? Well, to to service that debt, to pay that debt back, you would require to increase tax. You would require countries that have borrowed excessive money during the crisis to increase taxes. Well, the problem is if you increase taxes, that is basically a slap in the face of countercyclical fiscal policy, which, as we discussed a minute ago, requires that various countries and the governments of various countries spend money when the economy is in the doldrums, and they become more conservative when the economy is doing well on its own. So it essentially, if you increase taxes during bad times, that's going to tie your hands with how you spend money. Okay. It also represents a challenge to central bank independence. High levels of public debt does, because once again, central banks' hands are also tied, because significant portion of your monetary policy is constrained by the amount of money you need just to pay other debt, right? So in other words, central bank can't just print money because it's already printing money to pay your other debt, right? Theoretically, of course, we know that individual countries in Europe cannot just print money, but this was an example of how central bank independence is constrained. It is also a serious source of asymmetry, in the sense that if you have a country like Germany, who is extremely conservative and does not engage in severe levels of imbalances as far as their budgets is concerned, and then you have a country like Greece that does engage in indiscipline, fiscal indiscipline, then what's going to end up happening is there's going to be asymmetric shocks. So even a small recession is going to have very big impact on Greece and very small impact on Germany. High public debt also creates vulnerability in the presence of multiple equilibria, which is what we discussed in case of Ireland specifically. We said, well, why did Greece, of course, Portugal always had fiscal indiscipline. So why did Ireland get affected? Well, we learned that Ireland got affected because after Greece was bailed out, investors started asking, wait a minute, Ireland also has slightly higher levels of debt. It may get in trouble, so we should probably not trust its financial markets as well and not invest in Ireland. So this is the case of multiple equilibria that gets created as a result of high debt levels. Of course, high debt levels also acts as a brake on growth. The higher the debt level, the lower the ability to grow, because once again, there comes a point where you have borrowed everything you possibly can as a country, and you can't incorporate any fiscal or monetary policy to induce growth. Okay. So, what were the solutions to fiscal discipline and public debt? One of the solutions that people learned after the financial crisis and the sovereign debt crisis was that instead of creating these weird mechanisms to bail out individual banks or individual countries, the idea was to put together something called Euro bonds, which are collectively issued by the Eurozone and are guaranteed by the Eurozone governments. And the idea is those bonds could replace some of the individual nations' debts, or it could be used for future bailouts, right, or future deficits. The idea is don't let Greece issue its own debt. Instead, do it at a Eurozone level. And the benefits to that is, well, first, it would cement solidarity, because all the affected countries would feel like, you know what, they're also a part of Eurozone, in the sense that there are other countries to help them out. The single market for Euro bonds would also allow it to compete very effectively with U.S. Treasury markets and U.S. Treasury bonds, and especially when it comes to other countries wanting to accumulate foreign exchange reserves, right? Um, third benefit is if it's guaranteed by all member states, Eurobonds would be considered safe because even Germany is guaranteeing, for example, Greece's bonds, which is not the case right now. But if Eurobonds were right now, as in after the financial crisis, but if Eurobonds were introduced, then Germany would basically indirectly guarantee Greece's debt. It would also end fragmentation of financial markets and unify those financial markets, because right now what's happening is you saw how interest rates on Greece bonds, the differential between the interest rates on 10-year Greece bonds and German bonds was as much as 25%. All of that would go away. There would be no divergence in interest rates because the bonds, there's only one type of bonds, and that is issued and guaranteed by all members of Eurozone. But there's opposition to this idea, of course, and the opposition is overwhelming because no government would want to underwrite the debt of another government without some sort of a guarantee that that government who's benefiting from this debt will not continue engaging in fiscal excess. And this is true in the United States too. We're in the heart of financial crisis, and one of the biggest challenges, we're in the heart of coronavirus crisis. And one of the biggest challenges we face right now is the Illinois Government Workers Pension Fund. So basically, workers of the government of the state of Illinois have a pension fund just like each of the other 49 states. The problem is the Illinois government fund has been severely underfunded, and they have a shortfall of, wait for it, $450 billion. That's $500 billion for one state. So in other words, their pension fund has $500 billion less than what it should have had. And now a lot of there's a lot of discussion going on among the government whether the government should bail out a state like Illinois and make it whole, as a result of coronavirus-related crisis and the pressure put on its pension fund. But other states are arguing, well, that would just incentivize excess spending by other states, just like Illinois did, because they realized that there's no price to be paid. Anyway, going back to European Union, there's significant, overwhelming opposition to this through similar reasoning. Public debt restructuring can be done by canceling large debt, but there's a problem with that. As a country, you never want to cancel debt that you owe to other countries because, one, it imposes costs on bondholders, right? So in other words, at no fault of investors who trusted you with their money, you are making them lose money, right? Second thing is, beyond the question of legality and fairness of this process, it also creates a new crisis in the sense that nobody's going to lend you money once you don't pay them the money the first time around. And this is true. A real life example of this would be a country like Argentina, who has defaulted on multiple occasions on its bonds, and as a result, it has been shut out of the financial markets. Finally, national bonds are also concentrated in national banks, as we have established before. Basically, if Greece issues bonds, it's the primary holder of those bonds are also Greek banks. And what ends up happening is, by not paying their bills, the Greek government is basically making the Greek bank lose money, which then defeats the purpose of bailing the banks out to begin with, right? Because then you're creating the same problem again by not paying your own bills. So, in summary, the official plan A for the Eurozone in the aftermath of the financial crisis, from everything that they have learned, is fiscal austerity and necessity of very large surpluses over a period of many, many years, because that's the only way you're going to pay the debt that you accumulated during the financial crisis. However, people believe, and financial markets believe, that this situation is just absolutely not feasible, because if you are austere right now, you're basically saying that you're okay with lackluster growth rates, which reduces tax revenue, which reduces your ability to pay your debt. So you're in this weird loop, and people think that there's a need for another crisis that would actually force governments into fiscal austerity. There is no plan B, unfortunately. But a small, insufficient level of debt cancellation may be accepted. And we've in this chapter you may have read $27 billion worth of Greece debt was forgiven for sticking to the austerity plan by its bondholders, which is primarily Germany. But the problem with this expectation of having your debt canceled is that it leads to very painful negotiation between the government and its investors. And as we have established before, many of the investors are its own banks or other governments. So it puts a sour taste in the mouth at a government level to basically forgive one's debt. And we have seen some crazy language around this area too. So Germany has bailed out, or basically bailed out through various institutions, Greece, Portugal, Italy, and Spain. And Greek government in the past has basically, when Germany asked for its money back, Greek government has reminded them of their exploits during the Second World War, which is pretty unsavory and uncalled for, especially because Germany is the one that bailed out various countries in trouble. Okay. Let's talk about what we learned in terms of how banks function. We learned in the aftermath of the sovereign debt crisis that banks are very weak, they are very fragile. New regulations have been put in place by the Basel Committee for Banking, and various national laws are enacted for banks to make the banks significantly more stronger. Bank supervision has been significantly strengthened by the regulators, and bank supervision is now delegated to the central bank, or the central bank of the central banks in Europe, which would be the ECB. As we mentioned before, a system has been created to pass on the regular supervision of 134 largest banks in the European Union to the European Central Bank instead of national banks. The crisis has also led to a surprising degree of fragmentation in the banking system. Specifically, we don't know if European Central Bank is ready, willing, and able to act as a lender of last resort for all of these banks, which is not the case in the U.S. Federal Reserve is the lender of last resort for large banks, and discount window borrowing is the facility with which banks can avail of funds when nobody wants to lend it money. Okay. Learnings for governance. One of the most important feature of the crisis is that pretty much de facto management of Eurozone is done by two of its largest countries, which is France and Germany. Tensions existed between the community principle and the intergovernmentalism. Specifically, a fresh reminder, the community principle is when the European Commission sort of top-down approach takes initiatives and member governments approve and disapprove. Remember, the European Commission is already made up of member countries. So it's the European Commission that takes initiatives and various member governments approve or disapprove. But what has happened in the financial crisis is there was a shift to intergovernmentalism, specifically individual governments taking initiatives and having other governments approve or disapprove. Well, here the balance of power was truly towards Germany and France during the financial crisis because they were the strongest economies, and therefore they played a dominating role in sort of identifying the solution and almost manhandling other weaker countries into submission. And of course, weaker countries wouldn't like that approach, right? But the justification for the shift is, sure, you could have intergovernmentalism in good times when there's actual time to respond to small crises. But in a crisis of this magnitude, you can't necessarily have 19 Eurozone countries collectively deliberate effectively in a timely manner and have a timely response come out. You have to have natural leaders that lead through this through a negotiation process. The final point is the survival of the euro as a currency. So now that we have observed weakness that is inherent in the euro, many people have thought that eurozone is doomed and it can never succeed. There are many arguments for it, and there are many arguments against its claim. And only time will tell whether not only euro as a currency, but the European Union as an experiment will continue where it started and basically continue to flourish as opposed to